Welcome to The Explainer. Today, we're going on a hunt for that holy grail of investing. You know, those high-growth stocks that could potentially double or triple or even more. But to find those real opportunities and avoid the ones that just blow up on the launch pad, we need a map. And that's exactly what we're building today, a framework to tell the difference.
Okay, so let's jump right in with a classic question to get us thinking. Would you rather put your money in a fortress, a stable, profitable giant, or a rocket ship, a company with explosive growth that's burning cash like crazy to get into orbit? So, what's the right answer? Well, there's no magic formula. It really depends on what you're trying to achieve.
To make that choice well, you can't just follow the latest stock market hype. You need a system, a framework, a repeatable process you can use to analyze any company, whether it's a fortress, a rocket ship, or something in between. And here it is. This is our 4-step toolkit for today. First up, we check the financial health. How much cash do they have in the bank? Then we dig into the business model and its moat. That's just its competitive advantage, the thing that protects it from rivals. Third, what's the growth outlook? What's the real potential here? And finally, and this one is absolutely critical, we assess the risks. This is our roadmap.
All right, let's put this framework to the test right now. For our first case study, we're looking at two totally different companies, the social media titan META platforms, and on the other side, an AI infrastructure and Bitcoin mining upstart called IREN.
So let's start with this number, $54.1 billion. That isn't revenue, it's not profit, that is pure, cold, hard cash left over for Meta in a single year. That's what lets them fund massive projects in AI, survive economic downturns, and pay shareholders. This is the very definition of a financial fortress.
And then you have this, a 355% jump in revenue, year over year. That is IREN. This is not a fortress slowly building its walls. This is a rocket ship strapped to another rocket ship. It's just pure explosive acceleration, all thanks to a big pivot into AI cloud services.
So what's the verdict? Well, look, there is no single best investment here. It's all about your strategy. Are you looking for the proven, lower-risk growth that a fortress like Meta offers? Or are you willing to strap into a high-octane, speculative rocket like IREN for a shot at potentially much, much higher rewards?
Okay, that first one was a pretty clear contrast. But what happens when things get a little murkier? When you're not choosing between a fortress and a rocket ship, but between 3 different rocket ships, all trying to get off the ground. Let's take a look at 3 speculative tech companies: BigBear.ai, SES AI, and Nevada Semiconductor.
Now, for unprofitable tech companies, cash is everything. It is their lifeblood. So this chart shows us their cash runway, basically how long they can keep the lights on at the rate they're currently spending money. And as you can see, all 3 have a couple of years to figure things out. But it looks like Navitas has the most breathing room, at least on paper. But here's where things get really, really interesting. Not all risks are created equal. So Big Bear depends too much on government contracts. SESAI has to prove its battery tech can actually scale up. Both are serious risks, a 9 out of 10. But then, look at Navitas. It's facing a potential revenue collapse. That is a 10 out of 10, full-blown crisis. Because if your sales are cratering, that cash runway we just looked at can disappear a whole lot faster than you think. So in this speculative showdown, SESAI kind of inches ahead. Why? Well, its revenue is actually picking up speed, and it has some big partnerships with major car makers. But let's be crystal clear here. All 3 of these are high-wire acts. You're not buying a sure thing. You are betting on which company you think can best navigate its biggest, most critical flaw.
All right, we've looked at giants, and we've looked at warring upstarts. Now let's broaden the search a bit and go hunting for hidden gems. Those smaller, under-the-radar companies. The key here is to hunt for a catalyst, that one specific make-or-break event that could unlock a ton of value.
So, our source material highlights 5 examples from completely different industries. We've got battery tech, biotech, even wave energy. Now, we're not picking winners here. The whole point is to use these to show you the types of catalysts you should be looking for out there in the wild. And this table shows you exactly what that is. It's the why now for each company. For the biotech stocks, the catalysts are about as clear as it gets. It's a thumbs up or thumbs down from the FDA on a new drug. A yes could mean the stock explodes, a no could mean it goes to zero. For a company like Comstock, it's more about landing a huge recycling contract. These are tangible milestones that you can actually track.
But, and this is a huge but, with that kind of sky-high potential comes extremely high risk. The source material is very, very clear about this. This is not a shopping list. These are volatile, speculative ideas that live or die based on perfect execution. They're more like lottery tickets than retirement plans.
So, after going through all these case studies, the fortress, the rocket ships, the hidden gems, what's the big takeaway? Well, we can boil everything down into a simple, powerful toolkit of questions that you can apply to any high-growth company you're looking at.
And here it is, your deep dive checklist. Before you ever invest in one of these companies, you have to be able to answer these questions cold. How long can they survive? What's their unique advantage? How will they actually make money someday? What could kill this company? And is the price you're paying right now justified by the story? This is how you cut through the hype.
Ultimately, this whole analysis isn't about finding the one best stock that's guaranteed to work out. It's about giving you the tools to find the right investments that match your personal goals and your tolerance for risk. So now you have a framework. The only question left is, what kind of investor are you?